Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, June 27th, 2018. It's a little before 12:30 Eastern Time as I'm starting this video, and I figured I'd do an overview of the broad markets. We'll keep this one pretty quick, and I'll get into some of the different indexes that I haven't covered lately. In fact, I just had a request within the trading room, as to what my targets are on SPY, what are my thoughts on the SPY, the S&P 500 tracking ETF, because I haven't covered that recently. My reply was I haven't covered it because right now, as you probably know, I've been bearish recently and still looking for more downside. And when you short SPY, I did a video a couple weeks back on a lot of defensive sectors. The staples have been bullish on, utilities, REITs. Those are all defensive issues, and they've all been doing well, which also doesn't bode well for the economy. It shows you smart money is now taking money out of the high growth, top-heavy FANG stocks and moving it into defensive issues. That tells you that they see troubles on the horizon despite, what's been, rosy economic data recently. Market always looks out 6 to 9 months ahead. So we'll see. But either way, my point was when you go long or short the SPY, you're shorting and going long the best stocks. Well, I'm sorry, if you short it, you're shorting not only Apple, which is in there in some of those high growth companies, but you're shorting those steady Eddie blue chip dividend paying stocks, utilities, consumer staples, Procter and Gamble, yeah, and name it. So that's one reason I think there's more meat on the bone. If my call for more downside plays out, you should have more meat on the bone for a short trade on one of the higher beta indexes like the QQQ Nasdaq 100 or even the small caps. So let's dive into the charts. And speaking of small stocks, you have large cap, mid caps, small caps, and then you even have what they call micro cap stocks. These are your smallest companies here. And this is IWC, the iShares Russell Micro Cap Index Fund ETF. So think of IWM except smaller companies. When these companies grow, some will go to the wayside. These small companies, they all don't grow. Some go away, and those that do eventually move up, and they'll be maybe in the Russell 2000 one day, and then go to the mid cap index. So let's just run through these to kind of give you an idea. Now keep in mind, the smaller a company is, the higher the growth rate. Typically, in a smaller company, obviously, Apple can't grow at the rate a little small, tiny startup can, and there's also a lot more risk. So what happens is you tend to see, especially towards the end of a bull market, when sentiment is at its extreme, people think the market will go up forever. That's when you tend to see I call it the dash or trash. You start going to those lower quality, smaller company stocks because there's no fear and everyone's just chasing beta. They're looking at the highest, return possible. So let's go with the most riskiest asset. And you can see here that these the microcap stocks have done very well. They're not too far off the highs, but as I've drawn out here, IWC trades very well to the technicals. These are all trend lines, what I call minor trend lines. Obviously, the primary trend is still bullish, but you can see these trend line breaks, and these are swift corrections. So what do we have now? We have the most recent trend line break right here and a back test. So I have it the way I had this line drawn, the breakdown back test. It's starting to roll over. PPO just made a bearish crossover. So there's the micro caps. And where do I think it's going? Well, if we can really get some traction on this sell-off, I think by year's end, I think we can come all the way back down here to about that 90, 60-ish, 90. I'll call it 91 level. That's about a 15, almost 16% drop if it gets there. So that's my take on that. We haven't seen very impulsive selling yet, but either way, that chart looks to me like this one's headed down following that most recent trendline break and back test. MDY stepping up the. Oh no, wait, I skipped small caps. Let's go in order here. So we look at IWM. Busy chart. I know it makes your head spin. I might have a clean board. Let me see if I do. I will just mark this one up. It'll only take a second. So what stands out to me, we take a look here. Hold on, I have to change drawing tools here. You have an uptrend line that we can draw here off the most recent highs. There you go. We can draw this any way you want it. We can draw a really tight trend line here. This is what I have on the 60-minute chart. So let's just go with this one right now, and I'll show you the 60-minute chart here in a second. And you look from this point here, you can see that prices have been diverging. Prices making higher highs while the momentum indicators are not keeping up. They're making lower highs. That's negative divergence right there. And so that's the simple view on IWM. Breakdown back test, like everything else, we had, I mentioned it the other day in a recent video, almost within pennies a bearish engulfing candle. We didn't quite take out the very top of that body, but close to it. And we had bearish engulfing candles on most of the, especially the higher beta stuff like the NASDAQ 100, semis, all that good stuff. So there it is. Looks like it's going down. This could be a potential bear flag right here. You can see these candles kicking out. You had impulsive selling. That's what they call the flagpole, these three big red candles, and then a little low volume upwards rally. That is, by definition, that's what a bear flag looks like. So let's see if it plays out. Let's take a look at 60-minute chart. Okay, I have another 60-minute chart. If you remember the site, we put this out as an official trade idea today, so I'm using a different board that doesn't show price targets. But just generally speaking, for those of you YouTubers that follow right side of the chart on the YouTube channel, this is what I'm looking at. Here's that trend line, pretty well defined, divergent high on the 60-minute chart as well. Breakdown, pulsar breakdown, back test. There's that potential flag pattern, but we kicked back to this 166.49 level. That was former resistance back here. You can see a lot of the reactions right here. That level one, call it 166.50 if you want to round up a penny, acted as support there. And now we went down through it with an impulsive red candle. That helps to validate that as an important support level. The fact that this big candle right here to the right of that line I just drew was a big red impulsive candle and a back test. I can't promise you anything, but I can tell you, I can promise you this. I think this is about as objective as a short entry gets when you have a breakdown, impulsive selling, and a kickback to resistance. You either short a security when the charts confirm, if you're looking for it, on a breakdown to support, and or your next objective entry is a bounce back to resistance. So, if it goes back up, maybe back tests a trend line at higher levels. I don't think so. But I can also say your next sell signal now would be if you look here on a break of this flag type pattern. I drew it a little sloppy there, but I think you get that. And you want to see it impulsive. You'll know it if you see it. Impulsive move once we start to take that out, especially when we take out these recent lows right here. Look for some impulsive selling and and it's just simple stuff. A bear flag, you simply take the measurement of the flagpole and add that to where the flag breaks down. That gives you a measured target. But again, we have some different targets on the official trade idea, as well as some longer term targets that I shared on that trade as well. So we may extend this trade if it starts to pan out the way I think it. Just to loop back to that original daily chart we were looking at, I did clean this up a little. Took a few of the trend line or the horizontal support lines off, but this is the bigger picture really that I'm looking at on the Russell 2000 or via IWM here. This rising wedge, there's that trend line that I talked about with the breakdown and back test. So this is a larger rising wedge. So maybe we come down, maybe another thrust up, but ultimately if we go on to break this level here, 160.19, I think the potential is to come down here at about that 145 level. But again, there's some stops along the way if that does play out, and we'll just have to, again, monitor the charts as they go. Let's take a look at mid caps, and we'll wrap it up with the large caps. MDY, this is the mid cap ETF. Again, another busy chart, not so clean, but just don't even bother with what's on the left of the chart. Let's just take a look right here. You can see a fairly well-defined uptrend line. So this is that similar to that wedge pattern I just showed you on IWM. We have a divergent high as well. The indicators are lagging with prices making a higher high. You know what? I'll be honest with you. I haven't updated this chart in a while. I could play around with these lines. I don't want to do it during the video. I'd like to study the chart a little further and kind of add some levels. But either way, when we go out to the long-term charts, like for example, this is a 10-year weekly chart of MDY, and this is the bigger picture. And sometimes it's easy to get lost or caught up in the world of the intraday charts, 60-minute charts, daily charts, especially if you're swing trading. But the bigger picture shows a lot of the major indexes are right at this primary uptrend line support. This is our bear market low back here in March 2009 when the last bear market ended. So here's a trend line that comes in, and yeah, there are not a lot of connections from this point to this point, but there are quite a few here. So you draw that trend line however you want it. Even if you draw it here, you have a pretty good trend line. And again, it does connect to those earlier points. So And you have a divergent high, negative divergence on the weekly chart. Small divergence, but it's pretty steep. Back here, we had that correction. There was actually a bear market in the mid caps back in 2015, 2016. It did, I believe the mid caps did fall, as did the small caps, more than the 20% threshold for a bear market. So you had divergence, you had negative divergence here. There was a really big correction back there. So again, we've had corrections or bear markets, if you will, within a larger bull market in the mid caps and the small caps as well. And you can see all those were foreshadowed by these negative divergences on the weekly chart. We've only had a few negative or a few divergent highs, and they were all good for technically bear markets. Now the thing is, we were well above this primary uptrend line when those two happened. They just took us back, or at least this one took us back to the trend line. If we get a break here, we're going to have taken out that bull market trend line. And just to run through all of them right now, I'll get to, I'm going to work my way up to SPY anyways. Let's just go ahead and jump in here on a weekly chart. Same story. Here's that. Actually, I need to take that away. We already topped. There's no divergent high right now in this S&P 500, and this is the stock market. If you're going to pick one index, you call it, what's the stock market doing? Well, in my opinion, it's not the Dow. It's only 30 companies. How representative of the entire U.S. economy is 30 companies. NASDAQ, you've heard me say it 100 times over. It's just basically a tech fund with an Amazon kicker because it's so tech heavy. Well over half of the stocks are all technology sector. You're also lacking other sectors in the economy. So if you want an index that's really indicative of the U.S. economy, this is it, the S&P 500. 500 companies, exposure to majority of the sectors and industries in the U.S. and here it is, it topped back here on what looks like a blow off top by all accounts so far, and that has proved to be the top. But more importantly, again, look at this. Here's that primary uptrend line, comes off the 2009 lows, March 2009, and we zoom in and we can see we're flirting with it right now. We've been flirting this for a while. So what I had said in the trading room today, during a healthy advance, when you come and visit a primary trend line from above during a correction, it's usually no more than a few weeks you visit it and then you go on and rally. And then you come back in this case, it was about 6 months later, tagged it 1 week and then rallied. Tagged it here 1 or 2 weeks and then rallied. But now it's clinging to this trend line like a sailor tossed overboard is clinging to a lifeboat. That's the fact that we've hit it and hit it and hit it and we keep riding on it. That doesn't show a lot of vigor, not a lot of buyers stepping in anymore and buying these pullbacks to support. So, it's like a hammer, tap 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 on a board or something. You tap it long enough, it's going to break. So we'll see. It hasn't broken yet. That's the thing, but if it does, it's not going to be pretty because we could be looking at more than just a another 10% or so correction. And here's that trend line. We go back to a 2-day period chart. You can see this trend line. It's really this is an alternative trend line. I just had it there on the weekly chart. Comes in off the early 2016 lows, referring to this orange trend line here. And you can see here we broke down and we've been back testing that now. Really since we broke below it. There was a little stick save back here on that first correction. I call it a shot across the bow that we had in late January into February. Then we had the next shot across the bow. We did break it, and we've been back testing from below. So there's another pretty well-defined uptrend line on the SPY. That's the S&P 500. And here's what it looks like on the daily. So we have some cross currents. There was a downtrend line we took out, back tested. So, you can play the glass half empty, glass half full, and I'm not going to deny it, and that's why I'm pointing it out here. I would be remiss not to show you we had a downtrend line. We broke out, back tested, and have since been moving higher. So if you look at it from this perspective, there's the near-term uptrend is bullish, and that lower arrow, if you tighten that trend line up a little bit, that might be a warning sign that trend has been broken. You can see there it is. So that's what you want to watch for on SPY, and if that does break, it's not the be-all end-all because the trend is still bullish until we start taking out these previous reaction lows, because the definition of an uptrend is a security making a series of higher highs and higher lows. And so far that's the case in the very near term. However, again, it's all based on your perspective. If you look at the intermediate term trend, which is this, so far, and there's some work to be done, but since we put in a high back there and we have a series of highs, we have 1, 2, and now 3 lower highs, and we have some lower lows. let's see what happens. And again, so it's anybody's game right here. You know my opinion on where I think we're going. I think we'll break that trend line, come back down, and that's something to watch. And if we do, then the intermediate term trend remains bearish. But look, we don't have a lot of room or work to do, I should say, to firm up the bullish case. If we can go in and take out this high, then of course take out this high, well, that pretty much uh, puts a knife in the heart of the bears. You know, ruins their case for more downside. So that's it. Those are levels to watch. I can't promise you what will happen, but I do think we do head lower here in the coming. And finally, the almighty Qs, QQQ. This has you know, been the strongest index. Again, not as diversified. It's, you know, largely due to tech. If you overlay a chart of XLK, the technology ETF, it'll nearly mirror the QQQ. But with that being said, those are the big companies that have lifted, also, you know, been the primary drivers behind the S&P 500 as well. So we're watching the Qs closely. Here's the trend line that I have drawn right now. The one that I'm most focused on, it comes off the mid 2015 highs. Really, if you look at the NDX, because there was a mini crash in the Qs. I remember I was, you know, trading that day, and this candlestick here doesn't appear on the NDX, so it's something like that. But it does. It's, you know, coincidentally or not, look where it stopped, and it lines up perfectly with this trend line. So again, the trend line on the NDX, the Nasdaq 100, the index that the Qs are tracking, begins right here, early 2016, just like that trend line I showed you on SPY, and I think the mid caps have it as well, and everything else, a lot of sectors as well. So here's the trend line to watch. And again, the point that I was made before in the S&P 500, during a healthy advance, it's one and done. You come down, kiss that, that's a buying up. You want to buy, pullbacks to support. Lasted a few weeks there, but then we had a nice advance. In fact, the strongest, most unidirectional advance in the history, or at least as far as volatility goes, the lowest period of volatility ever seen in the financial markets. Just market went up, 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 day after day. That was, you know, the initial Trump pump, and then whatever carried on, and then you can see, boom, hit it. Had a nice bounce. A buyer stepped in, but boom, we came back down again. Had a lot of tests so far, and we're not off to the races like we were in the past. But it's anybody's game, and right now, I don't care how bullish, bearish you are, you cannot argue that the trend is still bullish until and unless we see a solid weekly close. This is a weekly chart, so you want to see a weekly break. Don't chase an intra-week break if you want the highest probability trade. Now, I'll tell you, I'm short positioned and may continue to be short. I'm always actively trading in and out of my stuff, but I think the next time we come down here, I think we ultimately go on to break that. And what tells me that are these divergences, a lot of other things that go beyond the scope of this video. I could talk for 10 minutes on sentiment and, you know, other things going on right there right now in the economy, but that's where we're at. And if we look real close, you can see a trend line which has been broken as well. There it is. There's a minor uptrend line right there, just like we had a minor trend line right here. Broken, broken, broken. So at the very least, I think we come back and visit this again. But the fact that we have these divergences on the weekly chart tell me this is not a dip or a pullback to the trend line that you want to buy. There are some dips back to support that I look to position long on if I'm bullish, and there's others that I look to position short on a break of. And that's what I'm looking at here in QQQ based on, again, numerous factors. And if you want to just keep it very simple, it's a wash, rinse, repeat strategy. You look for these divergent highs on the daily chart, correction, divergent high, correction, divergent high, correction. Now we have a divergent high, and there it is. So that's, I think, everything I wanted to cover. I think we can keep this video brief. Let me see if there's anything else. Really not much more. If you've watched the recent videos or checked the, you know, even if you follow the YouTube channel, there's still a lot of put up public charts on the site as well, such as a QQQ 60-minute chart. This is a 60-minute chart, rising wedge, breakdown, hit my first, actually, this was my first target hit here. We hit my second target zone, bounced. Still have that third target zone. These are, again, charts that I posted on the site recently. And then I also covered it in this 15-minute chart, put it up yesterday, the day before. These are fib levels. I had that other chart with additional lines drawn showing you my preferred bounce target right here, that 38.2 fib. There was a gap right there. And then my uppermost bounce target right here, the 50% fib. So far, we tried to punch through. You know, we hit it yesterday and reversed right on the button on that 50% or 38.2 fib right there. Today we had a little kickback. We tried to take it out, but we failed. You can see there. Traded above it for just a little bit intraday today, but we're back down below it, and that's pretty much a rejection. If there was a lot of buyers in this market, they took that level out. They should have ran it up to the next fib, which is also, by the way, price support as well. It's not. I try to align my fibs with the nearest price resistance levels or support levels, and you can see, a lot of reactions along the way here. So, and that's still a possibility to be hit, until we take out the recent lows. It's anybody's game, but so far, this seems to be where the rally has stalled out, and that's where I think it probably will stall out. Uppermost, you can see the 61.8 fib. You can see some reactions along there as well. So that's certainly a level that if the Qs get there, this would also be an objective shorting entry, yeah, around what is that? About 174 and change, close to 175. There it is, 174.85 or so. All right, let's wrap it up there. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.